How much money are you losing right now by not understanding the difference between an ETF and a mutual fund? You know, the average investor, Indian investor, loses around 47,000 per year due to poor investment decisions. And that's over 23 lakh rupees in a 50-year investment journey. And in 2025, with interest rates fluctuating and markets more volatile than ever, making a wrong choice between ETF and mutual fund could be the difference between you retiring comfortably or working well into your 70s. Hi friends, I'm Rohan, and today I'm going to explain exactly how to choose between ETFs and mutual funds in 2025. I'll also reveal the top ETFs that smart investors are flocking to right now. By the end of this video, you will know exactly which option is right for you and have a clear action plan to maximize your returns. Now let's start with the most fundamental difference between an ETF and a mutual fund. The difference is how they are being traded. Now, mutual funds are essentially portfolios of stocks. For example, if you buy a Nifty50 mutual fund, the fund manager purchases stocks from India's top 50 companies in the same ratio as they appear in the Nifty50 index. But here's the crucial limitation of a mutual fund. All buying and selling happens at the end of the trading day. Let me explain what this means for you as an investor. Say if you place an order to buy a mutual fund at 9:15 in the morning, your money is deducted immediately, but the actual transaction only happens after 3:30 p.m. when the market closes. The fund calculates its net asset value, that's NAV, after market hours, and that's the price that you get. It typically takes 1 or 2 days for the units to reflect in your account. Now, when selling, it's the same process but in reverse order. Where you place the sell order, it's processed at the end of the day, and you receive your money after 24 to 48 hours. Now, ETFs or exchange traded funds work completely differently. The exchange traded part is a key. The ETFs are traded exactly like stocks. You can buy or sell them at any point during market hours, and the transaction happens instantly. When you buy an ETF at 9:15 a.m., you own it immediately at the exact price that you saw, no waiting until the end of the day. Now, this is fundamentally the biggest difference between ETFs and mutual funds. The second major difference is the cost. ETFs are usually cheaper than mutual funds. Why? Because ETFs typically track an index. They follow a passive investment strategy. On the other hand, mutual funds, especially the actively managed ones, employ large research teams with highly paid analysts constantly buying and selling securities and shares. This active management requires significant expenses that get passed on to you as an investor. ETFs, on the other hand, simply track an index, like say Nifty50. They don't need extensive research teams because they are just mirroring the index. And the rebalancing happens once in every few months. Now, this makes the expense ratio, what you pay for the fund management, much lower for ETFs compared to mutual funds. Now, some ETFs have an expense ratio of as low as 0.7%, while the actively managed mutual funds might charge 1 or 2%. To put that in perspective, say on a 10 lakh rupee investment over a period of 20 years, the difference between 0.07% expense ratio and 1.5% expense ratio could be over 5 lakh rupees of lesser returns because of higher expense ratio. The third difference, which is particularly important for young investors, or those starting with small amount is the minimum investment required. See, with mutual funds, you typically need to invest a minimum of 500 rupees or 1000 or even 5000 rupees in some cases to get started. Now say if the NAV of the mutual fund is 10 rupees and you invest say 500 rupees, so in that case you will need to buy at least 50 units or you get at least 50 units. But in ETFs, you can buy even a single unit just like you buy a single share of a company. The next significant difference between ETF and mutual fund is the loan advantage. Now, this has recently emerged in favor of mutual funds, the ability to take loans against them. This is called as LAMF, that is loan against mutual funds. Say imagine you have 1 lakh rupees invested in mutual funds and you suddenly need money for an emergency. Now, what are your options? Say you could take a personal loan at 13 to 15% or in some cases 16-17% interest depending on your credit score. Or with LAMF, you would get a loan using your mutual fund as a collateral. Now banks typically offer 50% of your equity mutual fund value or up to 75% for your debt mutual fund. So on your 1 lakh equity mutual fund, you can get a loan of say 50,000 and in case of a debt mutual fund, you can get a loan of up to 75,000 and the best part is the rate of interest which is fixed at 10.75% or 10.75% which is fixed. So, on 50,000 that's the interest that you pay is about 5,375 rupees per annum which is close to maybe 400-450 rupees per month. You only need to pay the interest amount monthly and the principal can be paid whenever you have money and you're ready to pay. The other advantage of LAMF are you don't need any credit score requirement over here. Plus, it's fast and straightforward online documentation process, so it's hassle-free. And the biggest advantage, there are no prepayment charges. The only catch is your mutual funds and their units are locked during the loan period. So you can't sell them until and unless you repay the loan. Also, not all mutual funds are eligible, particularly the ELSS tax saving funds which come with a lock-in period of 3 years. Currently, this loan facility is not available for ETFs. So this gives mutual fund a significant advantage over the ETF. Now let's talk about which ETFs are performing exceptionally well in 2025 that you might want to consider. Now an important disclaimer over here. This is based on my personal research. None of these ETFs have paid me to mention their name. This is not a financial advice. I'm not a qualified financial advisor or an expert. So please consult your financial advisor before making any investment decisions. I'm just sharing my personal experience over here, which may educate you and help you in taking a right decision. So let's start. The first ETF is the SBI Nifty50 ETF. The Nifty50 has consistently delivered a stable return over a long period. Now, this ETF has an average return of 23.6% over the past 5 years. The best part is its expense ratio is only 0.04%. See, making it practically free to own this ETF. Plus, it gives you an exposure to India's top 50 companies. For example, a 10,000 monthly SIP over 20 years and your money could grow potentially close to 1.5 crore based on the historical performance of this ETF, so which is excellent. Number 2 is the Nippon India ETF Junior Bs. This ETF tracks the NiftyNext50 index. The companies ranked from 51 to 100 in market capitalization. Now, these are slightly riskier than the top 50, but potentially offer higher returns. This ETF has delivered a 24% CAGR return in 5 years meaning your money has more than doubled in 5 years. So for young investors with a higher risk appetite, this can be an excellent choice to capture the growth of emerging companies. The expense ratio of this fund is slightly higher, it's around 0.17%. Now the third ETF is the Motilal Oswal Most Shares Nasdaq100 ETF. Now if you want to invest in international markets, specifically the US market, the US tech giants, then this ETF is a great option. It tracks the Nasdaq100 index, which includes companies like Apple, Microsoft, Amazon, Google, and Meta. The 3-year annual return has averaged to around 25.2% CAGR, though this is too high and this may not be sustainable in the long term, maybe. But if you think of diversifying internationally, which can protect your portfolio from country-specific risk and give you exposure to global growth stories, then this is a good option. The expense ratio of this fund is 0.58%, which is again slightly higher. The last ETF is the Nippon India ETF Gold Bees. Now, gold has performed exceptionally well over the past 5 to 10 years, delivering returns that have even outpaced the Nifty50 in some periods. This gold ETF has given a 13% CAGR in last 5 years, so nearly doubling your investments. See, gold serves as an excellent hedge against inflation and market volatility. So now, what should be your selection criteria for an ETF and a mutual fund? See, when choosing either a mutual fund or an ETF, your selection should not be solely on the basis of 1-year returns. Look at minimum 3-year performance and ideally 5 years or more. See, many funds can look heroes or rock stars or even a disaster over a single year. But consistent performance over 3 to 5 years reveal their true character. Now, a big question that arises before you is, which product of investment should I prefer to invest? So let me share a quick example. My friend Rahul started investing 10,000 monthly in Nifty50 ETF in 2020, while his colleague Amit put the same amount in an actively managed large cap mutual fund. Now after 5 years, Rahul's ETF with an expense ratio of 0.07% grew to 8.9 lakh rupees. On the other hand, Amit's mutual fund with an expense ratio of 1.8% grew to 8.1 lakh rupees. Now that's a difference of 80,000, which is because of expense ratio, and that too in just 5 years. So now you would say ETFs are a better option. But when Rahul needed 2 lakh rupees for a medical emergency, he had to sell some of his ETF units. But Amit, however, took a loan against his mutual fund. That kept his investment intact and he could repay the loan over time. This real example shows how both instruments have their place in a well-planned portfolio. So both instruments are important. To summarize, ETFs offer immediate trading, lower cost and smaller minimum investments, whereas mutual fund offers the advantage of loan facility and might be preferable for long term. The ideal strategy for most investors is to have both in your portfolio. Use ETFs for sectors you want to enter and exit tactically, and use mutual funds for long-term wealth creation where you might not need liquidity access. See, remember, the best investment strategy is the one that matches your personal financial goal, time horizon, and risk tolerance. I hope you find this video useful. If you did, please hit the like button and subscribe to my channel for more practical financial content like this. So this is Rohan signing off for today. Stay financially wise and I'll see you in the next video. Till then, bye-bye. Take care. Jai Hind.